every single day. Billions of dollars change hands between people who, frankly, have absolutely no idea who they're trading with.
Oh, yeah. Not a clue.
Right. I mean, you've got a teacher in Chicago selling 100 shares of some tech company, and like a retired engineer in Tokyo buys them. They'll never meet. They'll never speak.
And yet neither of them is losing even a moment of sleep over the possibility of, getting robbed by a stranger on the internet.
Exactly. They just click a button and the transaction is ironclad.
It's totally seamless.
So how is that level of absolute, unshakable trust manufactured across the entire global economy? Because for a lot of people, the world of finance looks like this walled fortress,
Oh,
High walls are all these complex mathematical models, and there's this murky moat of financial jargon that feels entirely designed to keep outsiders on the outside.
yeah, the jargon is intense.
It really is. But hey, if you are listening to this right now, you are our resident learner. You aren't here to just stand on the edge of the moat. You're here to bypass the information overload, skip the noise, and get straight to those aha moments. So today, we are handing you the keys to the fortress.
Which is, honestly, the perfect mission for this deep dive. Because the financial market isn't magic, right? It's machinery.
Right?
And once you actually understand how the gears turn and what the vocabulary actually means in plain English, that massive, imposing fortress just becomes, well, a very large, very efficient factory.
A factory. I like that. And our blueprint for this factory tour today is Chapter 2 of the NISM Research Analyst Workbook. We are going to decode the exact structure, the vocabulary, and the inner workings of the securities market.
Yeah, we're going way beyond the basic definitions here. We want to look at what these financial products actually are, who the really heavy-hitting players are, and how the underlying plumbing keeps the whole global economy from just grinding to a complete halt.
Okay, let's unpack this starting with the foundation. Because we aren't going to bore you with the textbook definition of what a basic stock or a bond is. I mean, you already know that. But why do we actually need this massive, interconnected global market for them in the first place?
Well, it all comes down to a fundamental, basically a planetary imbalance. On one side of the economy, we have what the text calls surplus income units.
Okay, surplus income unit.
Right. These are like households that spend less than they earn, or maybe sovereign wealth funds with massive amounts of idle savings. They have the money, but nowhere productive to put it.
Makes sense.
And then on the exact opposite side, you have deficit income units. These are corporations that want to, say, build a new semiconductor factory, or governments that need to build a nationwide high-speed rail network.
So they have the productive ideas, but they don't have the cash.
Exactly. They do not have the capital.
So the securities market is essentially a giant reservoir and irrigation system. You have all this water, which is the capital pooling up completely harmlessly on one side, and you have crops that desperately need growing on the other.
I love that analogy. Yeah.
The market is just a system of pipes that channels the water from where it's idle to where it's productive. But actually, let me challenge that premise for a second.
Sure. Go ahead.
If you flip on the financial news on any given day, the stock market is often framed like it is just a giant casino.
Oh, all the time.
Right. It's just people placing highly leveraged bets on flashing red and green numbers. So does this massive, complex system actually serve a real, tangible economic purpose for the broader economy?
The casino perception is incredibly common, and honestly, it's pretty justified when you only look at the day-to-day price volatility.
Yeah, the day traders.
Exactly. But the underlying economic purpose isn't just real. It is the absolute engine of modern civilization. The magic of the securities market is that it aligns completely opposing needs through a mechanism called liquidity transformation.
Liquidity transformation. Okay, break that down for me.
Think about that company that needs to build the semiconductor factory. They need billions of dollars, and they need it for, say, 10 years.
Right. Factories take time.
Exactly. They cannot have investors knocking on their door asking for their money back halfway through the construction process. So they issue a 10-year bond.
Okay.
But what average investor wants to lock their savings away, completely untouched and completely inaccessible for a whole decade?
I mean, nobody. You might need that money for a down payment on a house or, like, a medical emergency next year.
Precisely. If we connect this to the bigger picture, the securities market solves this stalemate entirely. It allows the investor to sell that 10-year bond to someone else on the secondary market at literally any time.
Oh, I see.
So the company gets to keep the money for the full 10 years to build their factory, but the investor effectively holds a short-term liquid asset that they can just cash out whenever they need to.
So by providing that liquidity, the market removes the fear of locking up your capital.
Exactly. It encourages those surplus units to invest their savings, which prevents money from just stagnating under a mattress, and that drives the entire productive engine of the economy.
That is brilliant. The long-term borrower gets their stability, and the short-term lender gets their flexibility, all because the financial claim is freely transferable.
You nailed it.
That makes perfect sense. So if the market is the irrigation system, let's look at the actual water flowing through those pipes.
And the financial products themselves.
Right. We know the vanilla instruments, right? Equity gives you ownership and risk, while debt means you're just lending money for a fixed return.
The basics, yeah.
But the financial engineering gets so much more sophisticated than that, especially when money crosses international borders.
Oh, absolutely. It gets wild.
Like, let's say an Indian infrastructure company wants to raise debt, but they really want to tap into American capital. They can issue a foreign bond denominated in US dollars. But doesn't that introduce a massive hidden danger for the company?
It introduces severe currency risk.
Right.
Let's say that Indian company borrows 1 million US dollars when the exchange rate is really favorable. But then, over the next 5 years, the Indian rupee depreciates significantly against the dollar.
Uh-oh.
Yeah, suddenly that company has to generate a substantially larger amount of rupees just to pay back the exact same $1 million debt.
So a sudden swing in the foreign exchange market could bankrupt a perfectly healthy infrastructure company.
Exactly. Which is exactly why the market invented masala bonds.
I've heard of those.
What's fascinating here is how masala bonds completely flip that risk dynamic on its head. A masala bond is a debt instrument issued outside of India, say, to investors in London or New York, but it is uniquely denominated in Indian rupees, not the local currency of the investor.
Oh, wow. So the foreign investor buys it using their pounds or their dollars, but the core value of the bond and all the interest payouts are strictly tied to the rupee.
You got it.
If the rupee drops in value, the foreign investor is the one who takes the haircut, not the Indian company.
Exactly. It's a remarkably clever way to attract foreign capital without betting the entire solvency of your company on unpredictable exchange rates.
That is incredibly smart. And it's not just debt that crosses borders. Equity does it too, right? Through depository receipts.
Yeah, depository receipts are just a phenomenal logistical innovation. Because let's say you're an investor in Chicago and you want to invest directly in a major Indian technology firm.
Okay.
To do that, traditionally, you'd have to open a brokerage account in India, navigate all these foreign exchange regulations, convert your dollars to rupees, and then trade during completely different time zones.
That sounds like a nightmare.
It is a massive friction point.
Yeah.
But a depository receipt, whether it's an ADR in America or a GDR globally, solves this by using custodians.
Custodian banks.
Right. A custodian bank located in Mumbai holds a massive block of the actual physical shares of the Indian tech company in a vault, essentially. Then, a foreign depository bank in New York issues receipts against those underlying shares.
And those receipts just trade on the New York Stock Exchange.
Exactly. In U.S. dollars during U.S. market hours, just like any regular domestic stock.
I always think of depository receipts like eating authentic international cuisine at a local restaurant.
Oh, that's a great way to put it.
Yeah, you get the exact same flavor, the exact same economic exposure to the growth of that foreign company, but you don't have to book a flight, deal with customs, or change your currency to enjoy it. You just order it off your local menu.
Perfect analogy.
Now, moving from international logistics to heavily engineered hybrid products, I'm looking at equity-linked debentures, or ELDs. These are always marketed as having principal protection while still giving the investor the upside exposure of a booming stock market. And I just have to ask, if I get my initial capital protected and I get to participate in the upside of a rising stock market, what is the catch?
There's always a catch.
Right. Why wouldn't every single portfolio in the world just be filled with these?
That is the exact critical lens you need when evaluating structured financial products.
Yeah.
The catch with ELDs and their cousins, commodity-linked debentures, it all lies in how they are synthetically engineered.
Synthetically engineered, meaning what exactly?
Well, when you buy an ELD, the issuer doesn't just take your money and dump it all into the stock market. They split it up.
Okay.
A large majority of your investment, say maybe 80%, goes into highly secure, zero-coupon fixed income securities. Over the life of the debenture, that 80% slowly earns interest until it grows back to your original 100% principal amount.
Okay, so that is my protection.
Right, that's the guaranteed part.
So what happens to the other 20% of my money?
That remaining sliver is used to buy complex derivatives like call options on an equity index. That is what gives you the upside.
Ah, I see.
But because only a fraction of your initial investment is actually exposed to the equity market, your potential upside is mathematically capped.
So if the stock market goes on this massive 50% bull run, my ELD is only going to capture a portion of that gain compared to if I had just bought an index fund directly.
Exactly. You are explicitly trading maximum potential profit for downside safety.
I mean, I can totally see the appeal for a conservative investor, but is that downside safety absolute? Like, are these things perfectly safe?
Not at all. And that is a critical misunderstanding many investors have.
Really?
Yes. Capital protection in an ELD only protects you from market risk, meaning if the stock market crashes by 40%, your principal is theoretically safe.
Okay.
However, that protection does absolutely nothing to shield you from credit risk.
Credit risk, meaning the risk of the company itself.
Yes, an ELD is, at its core, an unsecured debt instrument issued by a specific financial institution. If the company that engineered and issued that ELD goes bankrupt during a financial crisis,
My money is just gone.
it evaporates instantly. Your so-called principal protection disappears, and you stand to lose your entire investment.
Wow. So capital protection does not mean guaranteed safety if the underlying architect goes under. That is a vital distinction to make.
It's huge.
Okay, so we have these highly engineered products, but where do they actually get built and where do they go after they are sold?
This brings us to the fundamental architecture of the market itself. The primary market and the secondary market.
The factory and the aftermarket.
Exactly. The primary market is the factory floor. This is where fresh securities are minted and sold directly by the issuer to investors to raise new capital for the company.
We all know about initial public offers, right? IPOs, where a company goes public for the first time. But I want to look at a specific mechanism within the primary market that seems a bit counterintuitive. The offer for sale, or OFS.
Oh, an offer for sale is deeply interesting because it utilizes the infrastructure of the primary market, but it doesn't actually raise a single dime for the company itself.
Wait, it doesn't raise money for the company?
Nope. In a traditional IPO, the company creates brand new shares, sells them, and puts that cash into their corporate treasury to build factories or hire staff.
Right.
But in an OFS, no new shares are created at all. Instead, existing large shareholders, like the original founders or maybe early venture capital firms, are simply selling their existing shares to the public.
So the money goes directly into their personal pockets, not into the company's treasury.
Precisely.
It's essentially an exit strategy for the early believers, but it's executed using the massive spotlight of the primary market.
That's a perfect way to summarize it.
We also see sweat equity issued in the primary space, right?
Right.
Where a company issues shares to its employees or its management team at a steep discount to reward them for their hard work.
Yes. And this isn't just a nice bonus. It's actually a structural tool to fix what's called agency risk.
Agency risk, meaning the managers don't act like owners.
Exactly. If a CEO only gets paid a flat salary, they might not really care if the stock price drops. But if you pay them in sweat equity, suddenly the CEO and the everyday shareholder want the exact same thing: the stock price to go up.
It aligns their motivations perfectly.
It really does. Now, once those securities leave the primary market factory, they enter the secondary market, the aftermarket.
Used car lot.
The used car lot, exactly. And the secondary market operates in two completely different ways. The first is the over-the-counter, or OTC market.
Okay.
This is where trades are negotiated directly and privately between two parties, usually massive institutions.
Yeah.
It is highly customized, but it carries immense counterparty risk.
Because there's no referee.
Right. If you make a private deal with a hedge fund and the market turns against them, they might just default and walk away.
Yikes.
Which brings us to the second way: the exchange-traded market.
Here's where it gets really interesting, and we actually go back to that question we asked at the very beginning. How do we guarantee a trade between two anonymous people on an exchange?
That is the role of the clearing corporation. They are the ultimate referee and guarantor.
Okay.
They manage the post-trading activities, clearing, which is calculating exactly who owes what to whom, and settlement, which is the actual legal transfer of the shares and the funds.
Right.
But their most important function relies on a legal concept called novation. When a trade is executed on an exchange, the clearing corporation steps directly into the middle of the transaction. It legally becomes the buyer to every seller
Yeah.
and the seller to every buyer.
Wait, hold on. So when I click sell on my brokerage app, I'm not actually trading with that retired engineer in Tokyo anymore.
Technically, no.
I am legally trading with the clearing corporation, and they are trading with the engineer.
Precisely. This mechanism virtually eliminates counterparty risk for you and the engineer.
Because if the engineer's bank account is empty and he defaults, I still get my money.
Exactly, because the clearing corporation guarantees it.
But I mean, by doing this millions of times a day, the clearing corporation is absorbing just an astronomical amount of risk.
Oh, a terrifying amount of risk. To prevent themselves from going bankrupt, they enforce brutal margin requirements.
Margins, okay.
First, they charge an initial margin, which is basically a deposit just to enter a trade, based on the statistical volatility of the asset.
Makes sense, like a security deposit.
Right. Then they charge mark-to-market margins, which settle the notional profits and losses of every single outstanding trade on a daily basis.
Hold on, stop right there. You lost me at notional profits.
Let me clarify.
Yeah, what does that actually mean for my bank account on, like, a random Tuesday? If I bought a futures contract for $100 and the price drops to $95 today, but I haven't sold it yet, why am I paying anything? The loss isn't real until I sell, right?
In a standard stock portfolio, you are totally correct. But in the world of exchange-traded derivatives, the clearing corporation doesn't care if you haven't sold. They look at your account at the end of every single trading day.
Oh.
If your position lost $5 in value today, they physically deduct $5 from your margin account and hand it to the person on the winning side of the trade, right then and there.
Wow.
That is mark-to-market. It ensures that massive losses don't quietly accumulate hidden in the shadows. By settling accounts every day, the clearing corporation ensures that everyone always has the cash to cover their positions.
That is a ruthless but brilliant system for preventing systemic collapse.
It absolutely is.
Now, to actually hold the assets being traded, we don't use physical paper certificates anymore, right? We use depositories.
Right. In India, it's the NSDL and CDSL.
They hold securities in a dematerialized or demat electronic form. It completely eliminates the risk of theft, forgery, or, your stock certificates just burning up in a fire. Okay, so we've built the factory, we have the aftermarket, and we have the referees enforcing the rules. Let's look at the heavy-hitting players walking onto the field. Not retail investors, we know what individuals do, but the massive institutional players.
The institutional space is where the real gravity of the market exists. You have foreign portfolio investors bringing in global capital. You have mutual funds pooling retail money.
Right.
But the most nuanced players are the alternative investment funds, or AIFs.
The AIFs.
Yeah. The text categorizes these strictly by their economic function, which dictates how they are regulated. Category AIFs invest in early-stage startups, venture capital, and critical infrastructure.
Things that help the country grow.
Exactly. Because these investments are deemed economically desirable for the nation's growth, Category IA funds often receive favorable tax pass-throughs.
They are rewarded for building the economy.
Right. Then Category 2 AIFs are essentially the catch-all for private equity and real estate funds that don't rely heavily on borrowing. But Category 3, that is where things get really aggressive.
Category 3 is the hedge funds, right?
Yes. These funds employ highly complex trading strategies. They heavily utilize leverage, meaning borrowed money, and they trade aggressively in derivatives to chase absolute returns.
Regardless of whether the broader market is going up or down.
Exactly. And because of this systemic risk, they face the strictest regulatory oversight.
Makes sense. We also see highly specialized entities like proxy advisors.
Ah, proxy advisors, they're fascinating.
Because when an institutional investor owns shares in 1,000 different companies, they cannot possibly analyze every single board resolution or CEO compensation package, right?
It's impossible.
So proxy advisors act as outsourced analysts. They evaluate these corporate proposals and advise the massive funds on exactly how to vote their shares to protect their immense investment.
It's a huge industry.
So if the clearing corporation is guaranteeing trades for these massive institutions, how long does that guarantee actually take to process? Because time equals risk.
Exactly. The timeline of settlement is crucial. The text outlines cash trades, which settle on the exact same day they are executed, known as T+0.
Okay.
Then there are TOM trades, which settle tomorrow, T+1, and spot trades, which traditionally settle on T plus 2.
But the global trend is pushing faster, right?
Oh, aggressively pushing toward T plus 1 or even T plus 0, because the longer a trade takes to settle, the more time there is for a black swan event like a sudden corporate bankruptcy or a global crisis to destroy one of the parties before the money even changes hands.
Faster settlement means less systemic risk.
Precisely.
Now, let's get into the why. When these massive funds trade, what is the actual underlying strategy? The text talks about speculating, hedging, and arbitrage. Let's break these down because they're often confused.
They really are.
Like, a speculator is taking a directional bet. They think the price of oil is going to go up, so they buy oil futures, often using borrowed money to amplify their profit. But hedging is the exact opposite mindset, isn't it?
Yes, hedging has absolutely nothing to do with making a profit.
Nothing.
Nothing at all. A hedger is motivated purely by the fear of loss. Hedging is the act of taking a deliberate position in a financial instrument to perfectly offset a potential loss in a real-world asset you already hold.
Okay, give me an example of that.
Imagine a wheat farmer. They are terrified that the global price of wheat might crash before their harvest is ready.
Right.
To protect themselves, they sell a wheat futures contract today, locking in a guaranteed price.
So if the actual physical price of wheat drops, their financial loss in the field is perfectly neutralized by their financial gain on the futures contract.
Exactly. They sacrifice potential windfall profits in exchange for absolute certainty.
And finally, arbitrage, the holy grail of finance. Buying an asset in one market and simultaneously selling it in another market at a higher price to lock in a completely risk-free profit.
In theory, yes. But the mechanics of arbitrage are self-destructing.
Self-destructing? How so?
Well, think about it. If a company's stock is trading for $100 on exchange A and $101 on exchange B...
Everyone's going to notice.
Right. Algorithmic arbitrageurs will instantly rush to buy millions of shares on exchange A and sell them on exchange B.
And that massive wave of buying pressure immediately pushes the price on exchange A up.
And the massive wave of selling pressure immediately pushes the price on exchange B down.
So within milliseconds, the prices converge, and the arbitrage opportunity completely destroys itself simply by being exploited.
Exactly.
The act of exploiting the anomaly is the exact mechanism that fixes the anomaly. That is a beautiful piece of market mechanics.
It's very elegant, and they execute these advanced strategies using derivatives, contracts whose entire value is derived from an underlying asset.
Right, like forwards.
Yeah, forwards are highly customized, over-the-counter contracts between two private parties to buy or sell something in the future.
And futures are the exact same concept, but they are standardized and traded on an exchange, which makes them highly liquid and guaranteed by the clearing corporation.
Exactly. Then you have options. Unlike a future, an option gives you the right, but absolutely not the obligation, to execute a trade. If you buy a call option, you pay a small premium for the right to buy an asset at a specific price. If the market skyrockets, you exercise the option and buy cheap.
But if the market crashes, you simply walk away and let the option expire, only losing your small premium.
Right, and a put option is the exact inverse, the right to sell. This raises an important question regarding market perception.
What's that?
Often, speculators and arbitrageurs are villainized in the media as greedy actors destabilizing the system.
Right, the casino gamblers we talked about earlier.
But if we look at the derivatives mechanics we just outlined, their actions are actually what inject vital liquidity into the system.
How so?
When that wheat farmer wants to hedge their crop to ensure they can feed their family, they need someone willing to take the other side of that trade. The speculator taking a risk on the other side is the very person allowing the hedger to protect their livelihood. The arbitrager exploiting a micro-penny price difference is the exact mechanism that ensures prices remain perfectly fair and efficient across all global platforms.
So every player, regardless of their personal motivation, is a necessary load-bearing gear in this great engine.
They absolutely are.
And we also see derivatives used in swaps.
Yes, swaps are deeply elegant. Let's look at an interest rate swap. It allows two massive institutions to exchange their future cash flows based on different interest rates without ever having to sell the underlying assets they hold.
So is it kind of like two neighbors swapping their mortgages?
Sort of, yeah.
Like, say one neighbor has a variable interest rate, and they are terrified that national rates are going to spike, so they desperately want stability.
Okay.
But the other neighbor has a fixed rate, and they are convinced rates are going to drop, so they want the flexibility to take advantage of that.
Right.
A swap lets them legally trade those interest payment obligations with each other, matching their specific risk appetites without ever having to actually sell their houses or refinance their loans.
That is exactly how it works.
Yeah.
They are trading the risk, not the asset itself.
So what does this all mean for the average investor when they hear these terms on the news? I mean, what does it mean for you, our listener?
Well, hopefully it means you aren't just looking at red and green arrows on a screen anymore.
Right. You understand that Masala bonds deliberately shift currency risk away from the issuer? You know that the principal protection of an ELD means absolutely nothing if the credit risk of the issuer goes bad.
And you understand that the clearing corporation's daily mark-to-market margins are the ultimate shield preventing systemic default.
You now understand the machinery. The jargon is no longer a moat. It is simply the operating manual for the factory.
That's a great way to summarize it.
But before we let you go, we want to leave you with one final thought to mull over, building on the mechanics we've just mapped out. We talked about dematerialization, the historical shift from physical paper share certificates being locked in vaults to digital electronic records held by depositories like the NSDL.
It fundamentally revolutionized the speed and safety of trading.
It really did. But what is the next frontier? With the rapid institutional adoption of blockchain technology and smart contracts, could the entire settlement process become instantaneous?
Moving to a true T+0 environment globally.
Exactly. Will the massive, heavily regulated infrastructure we just explored, the clearing corporations acting as middlemen, the depositories holding digital ledgers, the daily margin requirements, will all of that eventually be completely replaced by a single, decentralized, self-executing blockchain?
That would change everything.
If that happens, it won't just lower the drawbridge, it will entirely reshape the walls of the securities market fortress. Something for you to think about as you continue your deep dive into the financial world. Until next time, keep learning.